Yeah, let's go to the question, please.
Define the term fixed cost.
We're talking about fixed costs. Fixed costs are costs that does not change as level of output changes. They don't change as level of output changes. Examples, rent, salary. These are fixed costs.
Explain the term profit margin.
So for profit margin, it is we're talking about the net profit margin or the gross profit margin. So for net profit margin, it is your net profit divided by revenue multiplied by 100. The gross profit margin is gross profit divided by revenue multiplied by 100.
Okay. B, use Ralph's estimate of the price elasticity of demand, line 10, to calculate the percentage change in demand for photographs if the price reduced by 10%.
So we'll go back to the case study now. Yeah, go to the third paragraph. Read it, please.
SB is the only shop in City D that prints photographs. However, recently a number of online competitors have started to offer lower priced photograph prints to customers. Ralph has noticed that his sales have decreased significantly because of this competition. Ralph estimates the demand for his photograph prints has a price elasticity of demand of 4.
-4.
-4.
Thank you. So now take us back to the question. The question says, use Ralph's estimate of the price elasticity of demand, which is -4, to calculate the percentage change in the demand for printed photographs if the price reduced by 10%. So that means we need price elasticity of demand. So there, what is the formula for price elasticity of demand? Percentage change in the quantity quantity demanded over percentage change in price. Percentage change in the quantity demanded over percentage change in price. That is price elasticity of demand. So here we have our PED already to be -4. So -4 equals percentage change in the quantity demanded. We don't know. We need to find it. Divided by the percentage change in price. The price changes reduces by 10%, right? So that means we have the first price, which is 100%.
Okay.
The second price will be 100 minus 10 because it is reducing by 10%. So we have P1 to be 100, P2 to be 90.
Okay.
So your percentage change in percentage change in price is P2 minus P1 over P1. P2, which is 100 minus P1, which is 90, divided by P1, which is 100. So that is 100 minus 90, that's 10 over 100. 10 over 100 is the same as 0.1.
Okay.
So we have our -4 equals percentage change in the quantity demanded over -0.1. So -0.1, you cross multiply to get the change in quantity demanded. So -0.1 multiplied by -0.1, 0.1 multiplied by -4 gives us 4. It gives us 0.4. So 0.4 equals to percentage change in quantity demanded. But we need change in quantity demanded, not the percentage. So 0.4 multiplied by 100 makes us to have percentage change in quantity demanded to be percentage over percentage. So 100 divided by 100 gives us QD. So 0.4 multiplied by 100 gives us 40%. So the percentage change is 40%, which is same as like 140.
Okay. 2, explain one way in which Ralph uses price elasticity of demand when making pricing decisions.
And so for price elasticity of demand, we said already we know what it means. It helps us to know the degree of responsiveness between the quantity demanded of a product and a change as a result of a change in price. So if that is what it does, it estimates it. So the first way in which Ralph could use price elasticity of demand is to determine the price at which it can sell its product to be able to generate revenue.
Okay.
That's the first point. The second point I wrote is that to know if the business could be profitable, you can measure if the business is going to be profitable or not. So if there's a change in price by 90, if your total revenue exceeds your total revenue TR2, that means your P2Q2 exceeds your P1Q1. That what I'm saying is your first price, which is 100, with the quantity which is 100. Now your second quantity is 140, and your second price is 90. So if 140 and 90 exceeds 100 and 100 in terms when you use your total revenue, then it means it's profitable. But you will be able to know because you're going to take away TR2 from TR1. TR1 is P1Q1. TR2 is P2Q2. Yes or no?
Yes.
So TR2 minus TR1 will show if it is profitable or not.
Yes.
Then the third point I make is that to know if there's need to use promotional methods such as discounts or to increase revenue. So using price elasticity of demand, Ralph will be able to know if it needs to give discounts on the product to be able to generate revenue.
Clear. So I only mentioned one of those.
Yeah, you mentioned the three.
No,
it's 3 points, right?
They said explain one way.
One, yeah, just choose one.
Okay.
Don't mind me.
That's okay. See, analyze one advantage and one disadvantage to Ralph of introducing job production.
So first you have to define what job production is. What is job production? Job production means it's an operational method of producing a certain specific product for the customer. That is job production. You are producing what the customer demanded for. So what is the advantage of using job promotion? Job production.
Okay.
It gives customer satisfaction. How is it customer satisfaction? It gives customer satisfaction because you are producing based on the specification of the customer. So if you are producing such products, customers will be happy because you are meeting the needs or wants of the customers.
Clear.
So that's the advantage. Then the problem about using job production is that it is expensive. It's costly because you are producing a unit, which means you are operating on a smaller scale. And operating on the smaller scale means you won't be able to exploit economies of scale.
Clear.
And on you being unable to exploit economies of scale means you're going to have a high average cost of production,
Clear.
which makes your business not to be profitable. Clear.
Very clear. D, recommend whether Ralph should use leasing or should sell his photograph printing machine as a source of finance for the equipment to make frames, or justify a recommendation.
So go back to the case. Second to the last paragraph. No, third to the last. They said Ralph would need specialized equipment to allow him to make the frames. The equipment would cost $10,000. He has identified two possible sources of finance for this equipment. The first possible source of finance is for Ralph to lease the equipment from the company that produces it. The lease would be for 5 years at a fixed cost of $400 per month. The second source is to sell photograph printing machine that he has. That is internal source of finance, sale of assets, for at least $10,000 to purchase the equipment to make frames. For me, I talked about leasing. What is leasing itself? It's a way of financing an acquisition, the acquisition of an asset without you actually purchasing it.
Okay.
That means you are buying this, you are using this, you finance the acquisition, you acquired this asset, but you are not paying, it's not going to be for you. But you have the opportunity to use it for that agreed period of time, which is 5 years here.
Okay.
Now, this takes us to the application of leasing. So the first thing is, if he uses leasing method, the application of leasing may include, yes, obtaining equipment to frame individual photographs. So if he's taking a lease, that means he will be able to make a frame for each customer. That is if he's able to buy that leasing agreement. Two, this allows Ralph to continue printing photographs. So the other advantage about buying or leasing is that Ralph is not going to sell his printing machine. So that means he will continue to print photographs and at the same time frame them. Two things are going to happen here. With leasing agreements, Ralph would not need to sell his printing machine. That means he will continue to make printings for the photographs and at the same time make frames for them.
Clear.
Those are two things it's going to be able to do at a time. That is an advantage. So the third point is that it is going to be for 5 years. So that means it's going to pay certain period of amount of money for the next 5 years, which means he's going to be able to use this equipment for as long as possible. And it's going to be consistent in his operation, which is good. It could increase its customer base and revenue. And the last point I make is that I talked about the amount. It's $400 per month, which is in a year, it's going to pay $4,800. And in 5 years, it's going to pay $24,000. That's the analysis about it. But what is the problem taking a lease agreement? The problem is that it is expensive. Unlike if he's going to buy it for $10,000. Normally, it's supposed to cost $10,000. but it doesn't have, Ralph doesn't have that amount, except if it sells is printing machine.
Yeah.
Do you get it?
Yes,
So instead of paying 10,000 at once, it's going to be paying 24,000, and still it's not going to be his. That is the problem about the leasing agreement.
Okay.
Any question about that?
No.
So we'll go to 2A. Just go to the question.
Define the term objective.
What is an objective? Objectives are the aims a business wants to achieve.
Yeah.
Okay.
To explain the term private limited company.
We call it a private limited company because it's an incorporated business that the owners are the shareholders.
Okay.
The owners are the shareholders.
Calculate the profit made from selling standard and advanced services and
How many marks are the second one? 3 points. So you can give the features of private limited company. One, shares cannot be transferred. That's the first one. And the second point I make it's a separate legal identity. It has separate legal identity. So the owners are different from the business.
Okay. B, calculate the profit made from selling standard and advanced services and outcome.
So we go back to the schedule. We have the price and cost information. For standard service, it is $250. The direct cost per service is $50, and the allocated indirect cost per service is $60. So we need to get the total revenue first. The total revenue will be $250 multiplied by, we have the quantity. They said sold 1,000 standard service and 200 advanced services. Yes or no? So the quantity for standard is 1,000. The quantity for advanced is 200.
Okay.
So how do we get our total revenue? Our total revenue is price multiplied by quantity. The price is $250 multiplied by the quantity, which is 1,000. So our total revenue for standard service is 1,000 multiplied by 250, which is 250,000.
Clear.
Then the cost for standard service is, we have the direct cost, which is 50, plus the allocated indirect cost per service, which is 60. That's 50 plus 60 multiplied by the 1,000. So that's 50 plus 60, which is 110, multiplied by 1,000, which is 110,000.
Okay.
So the profit for standard service is 250,000 minus 110,000, which is 40,000, which is 140,000. Then we go to advanced service. The advanced service is 400 per one, which is 200 in 200 quantities. So the total revenue is 400 multiplied by 200, which is 80,000.
Okay.
Minus the total revenue or total cost, which is 60 plus 100, 160 multiplied by 200, which is 32,000. So the total, the profit is 80,000 minus 32,000, which is 48,000. So the total profit for standard service and advanced service is 140,000 plus 48,000, which is 188,000.
Perfect.
So the second question says,
State one possible problem for AB of trying to allocate indirect costs.
for you to allocate indirect cost is that one, it is difficult to allocate here because we don't have, we can't attribute the cost to specific outputs. We can't. We only have indirect cost. We don't know what service, what has happened. We don't know what overhead has been incurred. We don't know nothing. So it's difficult for us to allocate it to which item in the production.
Clear.
Did you get the point I made here?
Yeah.
It is, we have allocated indirect cost per service. But how do we incur this cost? We don't know. So it's difficult for us to allocate it.
Yeah. Analyze two below
The line promotion
methods that AB could use to increase the sales of advanced services.
First, you define what below the line promotion means. Below the line promotion method is a promotional method that a business uses without the media. So whatever promotional method you use that does not involve media like newspaper, radio, TV, is below the line.
Okay.
Then if it is above the line, it means you are involving media.
Okay.
Clear, right? So the first one you could use is sales promotion, which could be BOGOF, buy one, get one free.
Okay.
That could increase revenue. The second one I wrote is personal selling. Is it Ralph? No. AB can directly talk to potential customers about the advantages of its services.
Okay.
Clear?
B, Recommend a new payment method for the machine, for the mechanics at AB, justify recommendation.
So the mechanics, what method is AB using? Go back, he said, the level of motivation, the second paragraph, the level of motivation of the mechanics is low. Many mechanics believe they are not paid well, and the conditions of work are dirty and noisy. AB uses a time-based payment. Excuse me. So that means it uses time-based payment, which might not be conducive for them. So they are not motivated anyway. So AB should, now they are asking us, we should recommend what other methods AB should use to encourage its mechanics, those that are working in the shop. The first one I wrote is about salary. With salary, it is fixed. So irrespective of, the only thing is they have to complete their task. So at the end of each month, they get such amount of money, which might, it might encourage them because it will be more rewarding for them. It does not involve the output or time they produce. The second one they could use, but the problem about salary is that they could consider it as being unfair if we have to get the same salary and some people are doing more than others.
Yeah.
So that could also demotivate them. Now go to piece rate. Piece rate is based on the output they produce. So each individual's whatever they work on is what they get paid for. So this could increase the speed at which they work.
Yes.
Yes or no?
Yes.
And that could make AB to be more efficient.
Clear.
But the problem about piece rate is that some workers, some of the mechanics might find a shortcut to do things, which might affect the quality. And if quality is affected, the reputation is at stake.
Yeah.
Any question about it?
No. Where is it?